And let's talk about this. So for Walmart, if we look them up right now, so let's go here. So we started out with Walmart US equity, and we could have started out with the WAC 5.8, lower WAC than target, and off of the EEO, we would have basically for 2019 EV to EBIT, was it 13.14 right now? Based on timing, yours could vary a tiny bit. We're trying to solve for something that's be close to that. We would then need an expected ROIC and an effective tax rate. So here's the thing. If we go to the, let's take a screenshot of this so we get rid of these trading things. Every time you trade, I get an email. If I go here to the RV screen and I go to custom, I could add in the operating ROIC. And for Walmart last year is around 12.3%. So we want something that's a future ROIC. So ideally, we probably would have wanted to do a valuation. But the thing about Costco, to some degree Walmart and Target, is that they're relatively predictable year over year. Not a lot of dramatic changes in the way they work in terms of their margins, their stores, etc. So I think that today is probably representative of tomorrow. So somewhere around a 12.3 ROIC today is probably the range they're probably going to be in tomorrow. If I thought it was different, I'd want to put in what I thought is representative of the future, but let's use about a 12.3. Next, we would need a tax rate. As I said, I care about a future tax rate. So for Walmart, one of the things that we'd probably want to do, if you go to the EVT, which is event, this is a list of all of their conferences they're part of, as well as their earnings call. If we go to their second quarter earnings call, it's the last earnings call, Bloomberg does a transcript of these calls as soon as they're over. So if you actually look in the transcript of the last meeting, and you'll see that you can actually search through a transcript. But if we search through the transcript for tax rate, then you'll see that in the transcript of the last earnings call, they're guiding the analyst to a tax rate of 32%. Okay, so what I'm saying is the companies themselves that are publicly traded want the analyst to use a reasonable assumption for tax rate. So that's what I'm saying. Usually the best way to get the company's tax rate is ask the company. So usually in the conference calls, the quarterly calls or the annual calls, they're usually going to be talking about the tax rate. So I'm just saying that's a better source for publicly traded companies. Yes, sir.
What's your opinion on the effective tax rate function?
Well, the effective tax rate is helpful because what I would say is option B for a company like Walmart is we go to FA and we look at, for example, historical data, and on my custom historical, like just raw data tab here, I have an effective tax rate. So we can see it was 30%, 30%, 32, 33, 31, 33. So I could have probably looked at this like we kind of did with Costco, averaged it out. I'm probably going to come up with 31-ish. So I'm not going to be that far off. What'll matter is if the company's tax rate in the future is dramatically different than it was in the past. So that's the one problem with looking in the past. So that's why I'm saying that the more better practice is to talk to the company itself. Because let's just say as Walmart does more international sales, unless the U.S. changes its tax laws for corporations, it's probably going to see a lower tax rate going forward, right? Because other countries have lower tax rates. Or same thing. As we get closer to tax reform in this country, if it ever happens and we don't have a 35% rate, drops to 20, well, that will also dramatically change things. So regardless, a couple different places. One, start with the transcript. Start with the analyst report. Same thing. Look up the analyst reports. they're going to have tax rates in their forecast. We can pull those out of there for the companies that they're covering. Or, as I said, alternatively, look historically, try and estimate. Same thing with ROIC. That's what we're trying to do. We're trying to get a reasonable estimate, but again, happens to be here for Walmart, 32. So essentially, with copying this formula over, with no growth, I get an EV to EBIT 11.7. So what kind of growth rate? Well, let's put in 1%. Add a couple more decimal places, just so it's easier. Oh, that one. Easier to see. 2%, obviously too high. 1.1, now pretty close. And as I said, if you get within a couple of basis points, that's probably good enough. So that's Walmart. If we did Target, same thing. If we look up Target, we see a whack of 6.9. We see an operating ROIC of approximately last year 13.6. So again, assuming it's representative, we'll use 13.6 as just a working proxy. In terms of tax rate, EBT, is that if I go to their latest earnings call here for the second quarter transcript, I'll search the transcript. And Target also, as I scroll through, they're talking about tax rate a lot. I had to read through this. But when we did this in the earlier class and we read through it and we were looking through it, it actually pulled out to be 32% as well for Target. That was the number they were using. So and again, same thing. They're off the EEO screen. Their current EV to EBIT for 2019, second forward year was 1101. 1101. So something like 1.35, something like that. Triangular. All right. Questions about any of the numbers or where they came from? And this is operating ROIC. Just make sure you remember that. All right. So this concept in multiples also is comparables called premium or discount. So it means basically if somebody's trading at premium, it means they're trading higher multiple. If they're trading a discount, they're trading lower multiple. So I want you to look at Costco. I want you to look at Walmart. And I want you to tell me why Walmart is trading at a discount to Costco. Why is Walmart trading at 13 times EBIT and Costco trading at 15 times EBIT? Looking at the data. What would explain it? All right, what about the spread? So this is what I mean on your answers, be specific. So spread is approximately how much?
It's around like 10%.
For who?
For Costco.
All right, so they got about a 10% spread at Costco, and they got about a 6%, 6.5% spread at Walmart. So Costco with its 10% spread is more attractive, therefore gets more cash flow, therefore traded at a premium. And
it's 5.6% growth rate.
And it's growing at 5.6% in the perpetuity versus 1.1%. So it's a combination of much faster growth and higher spread that's leading to the higher multiple. Does everybody see that? Tax rates are not really that different. They shouldn't be within the same industry for peers. So therefore, we can see that's why they're trading at 15 versus 13. Right? And I've said this in the other classes. I'll say this to you. Watch CNBC tonight, and you will see people spouting off crazy things outside of Kramer's show before or after, right? Because here's what, seriously, you'll see a fund manager get on CNBC tonight and say this. You should buy Walmart because Walmart's a bargain, right? You're getting Walmart at 13 times earnings and Costco's at 15 times earnings, so Walmart is cheap and you should buy Walmart and you're going to make a lot of money. What's the flaw in that statement? Is Walmart cheap? Should Walmart be trading at 15 times earnings? Why not?
They just don't have they're just not creating value.
We'll be specific with these multiples. What's Walmart going to need to get to the 15 times earnings?
Higher ROIC,
Or,
lower WACC, or higher growth.
yeah, they either need more spread or a lot more growth to trade at 15 times. So that's the point. What people kind of naively learn, you got to start somewhere in finance classes, is everybody trades at the average. Well, average means average growth, average spread. If you don't have the same growth and spread, you're not going to trade at the same multiple. So for Walmart to trade at Costco's multiple, they need to be growing a lot faster. Otherwise, they're not going to trade at that multiple. Does everybody understand that? So that's what I'm saying. It's not that Walmart's going to suddenly trade at 15. It's unless something fundamentally changes about their business. So there's a fair value that the cash flows are based on. And that's what I mean by the key value drivers that we're seeing here in the multiples. All right? So why is Target trading at a discount to Walmart? So it's trickier. Finance folks. Because Target has a slightly higher G, 1.3 versus 1.1, and Target actually has about the same, if not a little bit higher spread, yet they're trading at a discount for the same tax rate. Why? And here's your hint, finance people. Time value of money. The word for the day, time value of money. Yes?
I was going to say, does it have to do with debt or equity investments?
Nope, it's based on the data on the screen. Time value of money. Take a cash flow you receive in 5 years. Present value that cash flow at a 5.8% discount rate. Take a cash flow you receive in 5 years. Present value it at a 6.9% discount rate. Which one's worth more? Why is Walmart trading at a premium?
It's got a lower WACC.
Exactly. So even though Walmart and Target have the same spread, because Walmart has an absolutely lower WACC that's substantially lower, their cash flows are going to be discounted at a lower rate, and that gives them a premium to Target. Does everybody see that? So it's risk. So in Walmart's case, it's risk. And what's going to drive WACC to some degree is your beta, which is your predictability. Walmart is more predictable, right? It doesn't see a lot of variance across time, right? And Target does. So since Target is a little less predictable and Target's going to bounce around a little bit about more, there's a risk premium associated with that. And so because Walmart is more stable, more predictable, people are willing to pay a little bit more for that, and they'll give them a little bit lower cost of capital. And that's the premium for predictability that's built into Walmart's stock price. But it's not enough to offset the lack of growth they have versus a Costco at the even higher spread and the higher returns that Costco has, even though Costco has a much higher WACC. Does everybody understand that? Because in your next homework assignment, which includes a 500-word paper, this is what you got to write. And you can't write words without numbers. You must refer to numbers, as I have been doing when I'm explaining this, because otherwise I don't know what you're talking about. You're just randomly babbling stuff otherwise. So this becomes key, but this goes back to multiples and why multiples matter. Now, when you get to your final exam, you get to your projects, what you're going to start doing, and you'll quickly start to, as you practice, what you're going to start doing is you're going to just see the multiples. You won't see the numbers behind this, and you'll have a general idea by just looking at the multiples why things trade at premiums or discount. So let me just give you a quick example of this. So let's go to a company like Apple. And let's look at their peers. And let's take the multiples template that we created in our last class. And let me just add to the multiples template operating ROIC. Not that operating ROIC, because this past equals future, but at least it'll give you a general idea of the range for the companies that they're probably going to be trading in the future. So look at, save this. Look at Apple and Google, Alphabet. And look at enterprise value to EBIT. Is Apple, which is trading at a discount? Why? Apple's trading at about 9, 8.84. Google's trading at almost 15, 14.94. Why is Apple trading at a discount to Google? We didn't do the math, but just what we know about the formula, superficially, why do you think, given some data? Yeah.
They have a higher WACC.
Okay, let's assume that for most companies, the WACs are probably in the same ballpark. That's probably not going to explain the 50% difference, but it could be WAC a little bit. So most companies in the same industry should have a similar WAC, and most companies should have a similar tax rate. So what's left? Growth and spread? Okay, let's look at the ROIC and the growth. Who's got the higher ROIC? Clearly Apple. That's why Tim Cook probably took over from Steve Jobs. He created one of the most profitable supply chains in the history of the world because he convinced a Chinese company, Foxconn, Hanhai Precision Manufacturing, to basically make iPhones for about $240, $230 and sell it to Apple, which you're going to buy in a day, the iPhone X, for about $1,050. And Apple's going to make all that margin. And basically Foxconn has taken all of the investment risk. And they're selling it to Apple at a cheap price. And Apple's going to have about 4 days of inventory because you're going to order it on Friday and they're going to deliver it to you next week because they're going to basically pay the Chinese company after you ordered it on Friday. So basically, it's great for Apple. They make a 500% ROIC. Why would that 500% ROIC, don't they have a higher multiple than Google, Alphabet? Yeah.
You're paying a premium for the higher ROIC.
But you're paying an 8 times multiple. Why? Why aren't you getting a higher multiple for that 500% ROIC if Google's making a 35% ROIC? And I'll give you a hint. What's the last thing? Growth. Now, LTG is growth in EPS. It's not the same thing as our G in our model, but think of it as directionally proxy. Google's growing a lot faster. So Google's G is going to be a lot higher. So that's Apple's problem. Apple's problem is not that they make a lot of money. Apple's problem is that a $240 billion company, they can't grow double digits anymore. It's just too big. They're too big. Google, which is a $100 billion company, which is impressive, is still growing at double digits. So they got a lot more growth. They're like Costco, right? Apple's like Walmart, right? Walmart's a bigger company, and that's the problem. You can't grow at the same percentages, so you're not going to have the same multiple. So that's the point. You can't say, and this is what people are saying, Apple's going to be the first $1 trillion stock, and there are people in the real world saying this because they're saying that Apple should have a multiple of 15, just like Google, so Apple's undervalued. No, you're wrong. Apple's not undervalued because Apple's growth is low single digits to shrinking. And you can see that in the EEO screen. Switch to growth, and you'll see that their revenue growth, because they're so freaking big, is, with the one exception of the iPhone X, is basically low single digits. And it has nothing to do with Apple being a good or bad company. It's just they're mature and they're gigantic. They're like Walmart. And so by definition, you're not going to have the same multiple. In fact, the opposite is going to be true. What's going to happen to Alphabet's multiple over time as they mature? It's going to go down. So what's more likely to happen in the future is that Google's multiple is shrinking as opposed to Apple's multiple expanding. Does everybody understand that? Key value drivers. But for purposes of your homework and where we need to start, it will be more helpful if you do the math, because that will help you before you start looking at a bunch of multiple data. This is where I want to start. By understanding the math, you'll do this. So for your group project, you each have a transportation logistics company in this section. You're going to have 6 companies on this list for your group project, yours and 5 peers. And you're going to have the math, and you're going to explain why you're trading at premiums or discounts. Just like we're doing here, we're going to practice with 3 different companies for your next homework assignment. That's what homework 9 is next week. Make sense? Okay, so before we finish, let's do the next piece. So this is the EV to EBIT. Let's add tab number 2, and let's look at PE, also known as the price to earnings multiple. So again, we're going to start with Costco. Key value drivers. Again, go back to PowerPoint. So what you learned in the book is that when we do cash flow to equity holders, which is what a price to earnings ratio really is, earnings per share based on net income, that's an equity cash flow. We can use the same key value driver formula, but replace it with NOPLAT becomes net income, G becomes growth in net income, ROIC becomes return on equity, and WACC becomes cost of equity. Same formula, actual PE. Okay, so let's use G, but this is growth in net income, not growth in free cash flow. Then let's look at the expected, what else is on there? Expected return on equity is what we need. We need the cost of equity. And I'm going to add a row for the expected net income. So for forward year 2, which is what we've been focusing on, let's switch back to Costco. WACC. Cost of equity, 9.3%. Not the 8.7 WACC, cost of equity in this one, 9.3. All right, expected returns off the EEO. 2019 price to earnings based on adjusted earnings, 23.05. That's the PE, 23.05. So we have value, we have PE, and we have the actual. And the actual that we're going to try and get close to is 23.05. We're trading at 23.05 times 2019 expected earnings today at this point, at that stock price. So let's go back. What is our expected ROE? Well, the thing is, analysts don't forecast ROIC, but they do forecast ROE. So for the next 4 years, 24%, 23%, 21%, 20%. Right? What I should do is I should add them up and divide by 4 to get a sense of the next 4 years. But for laziness, which you can't be lazy, I can, I'm going to call this 22. Okay? Expected return on equity in the future. Expected net income, 2019, adjusted 3087. So, what is the formula? Key value drivers equals left paren, net income times left paren, 1 minus growth divided by return on equity, right paren, divided by left paren, cost of equity minus growth in net income. That would be the value. And if I take the price divided by the earnings, that would be the PE with no growth. So what's my growth? 4%, 5%, 6%. Seven, 6.3, 6.2, 28 granular. There you go. That's what explains the PE of Costco today. Yes.
Can you just go over your formula one more time?
Just the key value driver formula with the correct order of operations. Questions? All right, let's do, in the interest of time, because we need to finish in about 7 minutes. All right, let's do the next one together. You can do it as an exercise, but just so we'll all have it, we'll do it together. So let's do Walmart and let's do Target. So again, to do Walmart, what do I need? I need to go to the EEO screen, and I need the 2019 second forward year. Start out with what I'm trying to get to for, oh, it's Costco. Walmart. For Walmart, forward PE 19.02 based on today's stock price. That's what it's trading at right now. 19.02. That's the number we're trying to get close enough to. All right. And that's the value that will help us do that. Okay? To get our PE in our model. Now, if I go back to Walmart, off this screen, I need 2019 net income adjusted, 13,559. All right. I need an expected return on equity. So 17, 18, 22, 19.9, so 20. So let's just say 19. As I said, you should probably add the 4 up, divide by 4 to get a better representation, but we need something representative. So I'm saying around 19%. At a cost of equity, whack, cost of equity of 6.6. So basically 1%, 2, about 1.7, 1.8, something like that. By the way, this value, 258 billion, should be close to the market cap of Walmart, 264. We're doing adjusted earnings, so it's adjusted PE, but based on earnings, should be pretty close. Okay, so Target, real quick. TGT, go out of order. Their WACC, 8.8, a little higher. We know by definition that's going to give Target a little bit lower multiple because they have a higher discount rate. All right, what else do we know about Target? EEO. We know that their 2019 adjusted earnings are 2330, smaller company. We know that their expected return on equity for the next 3 years, 22, 21, 20, 21, so let's call it 21. And if I pull through the formula with no growth, their actual PE on adjusted earnings is right now 14.11. Now this G, remember, is growth in income. The other G is growth in free cash flow, so a little different. Close enough. So what matters next is explanation. So let me ask you this. Why is, I'll use different words, Costco trading at a premium to Walmart on their PE? Why is Costco's PE a premium to Walmart? 23 versus 19. What do we know? A higher expected growth rate of 6.18% versus 18.85. At a spread, Costco spreads about 13 and Walmart spreads about 13. So for relatively similar spreads, what's really benefiting Costco is the much higher growth rate, and that's what's driving their PE. Everybody see that? Questions about that?
Could you also say it's like the higher cost of equity?
Well, what I'm saying is if they actually had the same predictability as a Walmart and therefore a similar cost of equity, their stock price would be off the charts. But they don't. And that's the nature of their business. Okay? But back to Target. Why is Target trading at a discount to Walmart, even though they have a similar spread and a higher growth rate? Higher cost of equity of 8.8%. They have the higher risk at Target. So basically, what's the real difference between Costco and Target? Because these are similar and these are similar. What's the real difference? That growth allows them to have a stock price that's 60% higher. That's why people are paying a premium for Costco. So let's flip it around. If you're the analyst following Costco, what's your entire model really going to be dependent upon? Growth. Tell me about same-store sales. Tell me about store openings. Tell me about what the retail environment looks like. It's all about growth. When's growth going to slow? Because when growth slows for Costco, watch out. Because when growth slows for Costco and they start maturing and they start looking like Walmart and Target, their stock price is way overvalued. So they are not doing that. That's not the expectation. They're plugging along at 7%, but that's why analysts are going to be asking, hey, what are you doing with e-commerce? What are you doing with home delivery? Are you going international? It's a growth story. We know you know how to run the business, but when is that growth going to mature and when are people going to erode that growth? It's all growth, 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 because that's what's driving the premium in their multiple. So as I said, for your homework assignment, I'm going to give you 3 different companies. You're going to have to do these 2 sets of multiples, and you're going to have to do a 500-word paper to basically explain, using numbers, why they're trading at premiums or discount. Good practice. We'll talk about this during our next class. Make sense? See you on Monday.